Video. This is Morris from sjoptions.com, and I'm working in the option colors software, which you can find at optioncolors.com. In today's class, we want to look at long-term charts of the SPX, just get an idea of where we are and where we could possibly go from here. And then we also want to test the VAR, value at risk, of various option strategies. And then along with that, we want to check the margin expansion on those strategies in case we trade with portfolio margin. So first of all, I already took a couple minutes here to draw in the channel height here. So we see way back before 2000 time, and then I just really drew the support and resistance at the floor and the ceiling of this channel, and it was a little bit over about 8.5 bars, just looking at the lines on the software. And then I drew the same distance up to the top. So, and most of you know this, but typically when we have a channel and then we break out, then we can expect the new channel to be a similar height as the channel below it. And the same thing can happen if we're going down. Okay, so since we've already drawn our support and resistance lines and then the different channels, we can see that we've just really broken through the second channel up here. So this top channel is actually reaching new highs and expanding a little bit larger than the bottom one. What that means is, well, we could be reaching a top here and come back through, because sometimes the points don't exactly match, which we can see down here, for example. So this particular trend extended about one of these bars farther than this one over here. And so that's something to watch for right here, as we've already done that. We can also watch for possible another channel starting way at the top here. So that could be a little bit more unlikely. Also, since we've already moved up so much since the beginning of 2010, way back 2009 looks like, and towards the end of 2008 when we had this crash. So we've already had a really long move up. Also, if we look way back here, this trend here, which was started in, it was about a 10-year trend from 1990 to 2000. We have about a 10-year bullish run, followed by a pretty serious market decline. Then we had a shorter run here, about 5 years or so. And then we had another decline that wiped out all of those gains. And now the current trend is like 8.5 years. Okay. I also want to look at the volatility charts. So now I've zoomed up on the price chart on the top back to 2002, and then we're looking at volatility on the bottom. I think it's interesting to look at the shape that we have in here and compare that to the shape we have over here. It's similar length as well, except for the newer trend's a little bit longer. But if you look through this range here, we're really approaching those same lows that we had in this area. And then after this, the volatility had a little spike and started to go up kind of slowly. And then we increased speed here, and then the market crashed right there. And you see that volatility went all the way up to about 80 from the lows. So that's one thing we want to be aware of, that, you know, although the market doesn't necessarily repeat exactly, it does over and over again behave in a similar way. You could just look at these charts and see how similar they really are. I wish I could like cut this out and just put it over here, but you can really look at this one, and then this part's a little bit different, but look at that. They even have a little spike here. This one has a little spike there, and then it's reaching that low, which is right here. And so next we want to see if we start to move up kind of slowly like this, and then beware of, you know, breakout. And so what would trigger that is if this up here. Well, let's say we're at the top and it comes back down, and then it gets to this support and it breaks through, then it can fall down to like through here to this other support. If it breaks through that, you're looking at way down here. And again, if we do fall through a couple of those support lines, there could be a tremendous sell-off because, again, investors who have been holding on for so long and have made so much since the end of 2008 would happily love to take their money out of the market, which could cause a crash, a free fall all the way back down. Again, I'm not calling that or anything, but we just want to watch because we do, again, oftentimes things happen like they did in the past. So right now, again, we're kind of over here. And so we want to see if this type of shape starts to happen with, maybe the price as well as volatility. And then we want to be aware of the possibilities. That's all. What would happen to your strategy if volatility rose like this and the price fell that way? So next we want to look at some strategies, see what would happen to them in this type of situation, maybe through something like this. And then we can start, back testing over here to see that exposure. And we want to look at the amount that our margin would increase if we have portfolio margin, and also the drawdowns that we would experience with various strategies. So let's move over to our risk profile. And you can see we're at September 25th, 2008. And we just want to see what would happen if we're trading this strategy during that time. We want to keep track of both our margin expansion if we're trading a portfolio margin account, as well as the drawdowns. So this trade is, it's a large trade with a regular standard margin account. You can see that the total risk is over 400,000. But if we measure down 10% and use a traditional Tim's margin method, the margin on trade's about 97,000 to start with. So I'm just going to make a note of that. Again, I'm measuring down 10%. And I can see that would result in a loss of about 97,000, and that's not including any increase in volatility either. But this is typically how it'll be margined at most brokers. And then if we measure 10% this way, we can see that it shows a positive gain, so the margin would be calculated on this side. Okay, so that's just a basic Tim's margin calculation, but you have to go to your broker for the exact formula that they're using. Now, as we advance through the trade, so we can go just a few days at a time, and we can see just a few days into this that the trade already has a drawdown of 197,000. So that's alarming, first of all, because the margin on the trade was only 97,000. And the current drawdown of the trade is about 200,000. So again, that means if you had used about 50% of your margin, that margin just doubled, and you would have a margin call because you also have, well, actually the new margin is way down here. Let's check that real fast. So, okay, so your new margin would actually be about 317,000. So you're going to have serious problems because your current trade is now down 197,000. So we have a loss, or at least a temporary loss. You have a drawdown 197, but your margin has already increased to 316,000, and it started at about 100. So our margin has tripled in just a matter of days here. It looks like I fast forwarded about 2 weeks. Okay, so margin went up 3 times. That means if you were using 30% of your margin, you just really hit the top. Margin triple, but the other serious problem is you're down 200,000 on the account. So you could be completely wiped out at that point. You'd have to do the numbers. But let's fast forward a little bit more. And then we went down here. So now the trade is down 274,000. And the new margin is 10% down, which is almost off the screen, but it's about 367,000 would be your 10% margin. Fast forward a little more, comes up a little bit, but you're still down an awful lot. Fast forward a little more, and now we've moved back down here. So now you're down 416,000, and your new margin is pretty much the max loss of the trade, which is 447,000. So let's just stop there and just quickly review some of the numbers. So again, your margin started about 97,000. In just 2 weeks, the margin jumped to 316,000, went up 300%. If you would have held on to the trade and kept going, again, this is not including any adjustments. We're just looking at the credit spread, and if you're just trading on probabilities and just putting them on and using the pop trading method. So after the full length of the trade, the margin's up to 447,000, which is an increase of 400%. Using portfolio margin, just standard out of the box formula. But your drawdown on the trade is also over 400,000, which again is quite alarming because the initial margin on the trade was only 97,000, and now you're down 400,000. I just think it's a good test. These are the things you want to be aware of. Again, especially with the market making these all-time highs, and you saw that the price chart at the beginning. So just be aware of what could happen as we're at those all-time lows on volatility, and then watch for the moves up in volatility, watch for some serious price drops, and don't let this happen to you, basically. So I hope you found that helpful. Thank you very much.